This is the Scrap Metal and Commodities Recycling Report by BENLEE and Raleigh Goldsboro Recycling, March 6, 2017. Last week, commodity prices were mixed and economic reports remained positive. On the left, we see U.S. steel production rose to a near two-year high, and importantly, production is about 25% higher than the start of the year. Oil fell $1, ending at $53 a barrel, about double a year ago. Importantly, oil is staying above $40 a barrel, which is helping drive increased U.S. drilling and pumping. The oil rig count rose again. At 609, it's about 93% ahead of the 316 low of about a year ago. A terrific increase. But let's not forget, it remains about a third of what it was about 2 years ago. Iron ore rose to $92 a metric ton, staying near its almost 2.5-year high, and is about 2.5 times what it was a year ago. Scrap ferrous prices show steady here, but as the week ended, prices were up about $30 a gross ton and more. Scrap demand remains good, but demand will be hurt a bit as Nucor's DRI plant that makes scrap metal substitutes comes back online in the coming weeks. Hot-dipped galvanized steel held at about $900 a metric ton after its recent rise. Stainless 304 scrap remains remarkably steady at 37 cents, as demand and supply hold steady. Copper rose to $2.69 after a week of ups and downs, but it remains about 40% higher than about 14 months ago. And we see the 5-year copper chart shows we remain near 2-year highs. Importantly, copper inventories continue to fall to about 7-year lows, which could support stable prices and, as importantly, bring more mining jobs online. Aluminum rose a penny to 86 cents after a midweek spike, and demand remains solid. We hear of more cars and trucks moving to aluminum, which should bring stable to higher prices in the months to come. The 5-year aluminum price chart shows prices remain near 18-month highs, and aluminum inventories remain near 9-year lows. China's GDP, gross domestic product, a key measure of the economy, grew at 6.7% last year, the weakest growth since 1990. Yesterday, China announced targeting 6.5% growth for 2017. Slower yet again, but still huge. Finally, U.S. 2016 GDP data is in, and we grew at 1.9%, another year of near 2% growth, which, while lower than historical growth, has led to record levels of employment and profits in most industries. While 3% or more is ideal, the economy remains very positive, which is bringing stable to higher commodity prices. The Institute of Supplier Management Manufacturing PMI Index, that's the Purchasing Managers Index, rose to 57.7 in February, an almost 2.5-year high based on rising new orders and increased demand, which has led to increased production and yet, frankly, reduced employment. The PMI index for non-manufacturing also rose in February to 57.6, the highest level in 16 months, due to a surge in activity, rising new orders, and increased employment. February automotive sales dropped a bit to 17.6 an annual rate, which may have the third year in a row of record sales. Car companies are offering huge rebates, which is a sign that a third year of record sales will be tough, though. Initial U.S. unemployment claims fell to 223,000 last week, the lowest level in 44 years, and is below the key level of 300,000 for an incredible 104 weeks. The U.S. economy clearly continues its growth. And Wall Street had a few bumps last week, but hit new highs again, which continues to bring value to investors, which will support more growth. As always, feel free to call or email me with any questions, and we hope all have a safe and profitable week.